Ladies and gentlemen, boys and girls, children of all ages, welcome back. Hopefully, you're at least 18. Welcome back to Stock the, the stock breakdown, where we're breaking down. Wait, we got Power Plug, Disney, and what's the third one?
NIO.
And NIO. Ladies and gentlemen, I am, of course, Phil Baird, the podcast mogul, your host with the most. And up to my left or right, depending on how you look at it, we got Tony, who is the brains behind Stock Bros podcast and one of the great admins here. And then we got Dult, the advisor from Banting Corp Capital Management, as well as one of the great admins to this group. So, ladies and gentlemen, you know, I know, everyone knows what this show is. We break down the stocks so that you don't have to while I sweat over here. Tony, what stock are we starting with today?
You want to start with Disney? What do you think?
Sure. I'll lead off on Plug in the middle.
All right. So I'm bringing up the Disney info that you showed. All right. So here's Disney over the last year to date. What's going on?
Yeah. So we got a little graph up on the screen, and that's just Disney's year-to-date returns. I would say right now, so some of the numbers I like to look at when I'm analyzing a stock, one of the very first ones I look at, other than just scouring the earnings report, is I'll look at the price to book ratio. And that gives you a good idea of what the market value is compared to the actual book value of a company. So right now, Disney's trading at around 3.9 to 1 ratio, meaning that the market value is about 3.9 or about 4 times higher than what the actual book value is of Disney. So right now it's definitely trading, in my opinion, it's definitely trading high. The thing is, Disney was in a lot of trouble when the pandemic first hit, and because all of their business model at the time was parks. You know, you bring your kids to Disney Orlando, to Disney
Hollywood,
California. Those were their big money makers. And what they did was they were in a lot of trouble. They were losing a lot of money. And what they did was they pivoted to their Disney Plus model. And they started really heavily promoting and marketing Disney Plus. And it was actually really smart. Give
me a second. You sent me a picture, so we're going to bring that up.
Yeah, because it really kept them afloat during the pandemic. And they were losing a lot of money during the pandemic months. And we could actually go and pull up the earnings report I did earlier. And they were losing a lot of money the last 4 quarters. And if you look at this chart, you can see that as of this one's a little bit outdated. Let's see.
Q3.
This one's actually from Q3 of last year. But it shows that Disney is now has over 100 million subscribers. I think
150 with all its products.
Yeah. So just Disney Plus, though, what I'm talking about. So just Disney Plus now has over 100 subscribers. And the reason why I bring up Disney Plus is because I think they're pivoting to a model where they're going to start releasing a lot of movies on Disney Plus instead of going directly to theaters. We just saw that with Black Widow, where they're charging $35 to buy or rent Black Widow. I think you probably buy it at
you buy it.
Yeah, you buy it for $35, and they sold over 60. I think they had over $60 million in profits in Black Widow when it first opened. And right now, with over 100 million subscribers, they're saying that the average subscriber pays about $4 a month. So you're looking at $400 million a month off of just Disney Plus subscriptions, which is pretty amazing. So I think that really saved them a lot, and they were smartly marketing that, and they were pivoting their business strategy to go to a digital strategy and provide more digital content, sell movies on there, trying to create new shows. They created a bunch of new Marvel shows. They created their big hit was the Star Wars show.
The Mandalorian.
The Mandalorian was one of their huge hits, and that helped drive new subscribers in a big way. I subscribed because of that show. It was a great show.
It's an awesome show. I can't wait for season 3 and the Boba Fett to come on.
I mean, Baby Yoda was the talk of the world.
I have a Baby Yoda, for God's sakes.
Right. So it's genius marketing. That show definitely paid off all its dividends. And you could see that they're starting to, like I said, they're starting to pivot their business strategy. They have more subscribers than Netflix and any other subscription base in the world, I believe, last I read. You can double check on that, but I'm not 100% sure. But the last I read a couple months ago, they were number one in the world. So it's pretty amazing what they did with that. And obviously, Disney is going to continue to thrive because as the pandemic ends and the parks start opening to full capacity, that's where they have all their bread and butter. That's where they're going to make all their profits. So I would say things are looking pretty good for Disney, and it's going to get better. But make no mistake, the pandemic did hurt them a lot. You can tell by their earnings reports and their balance sheets in the last 4 quarters, they did lose a lot of money. But like I said, Disney Plus kept them afloat. I think as far as buying it right now, I personally wouldn't buy it right now because I think it's trading too high. I would wait to see if it can get it at maybe 155-ish range, maybe 150, because I still think 183 is way too high, but that's my personal opinion. So that's really my opinion on Disney, and I'll kick it over to Dalt.
Well, let's bring Dalt. Dalt, what is your opinion? Do you want to add anything to what Tony said about Walt Disney?
Yeah. Total subscriber base is not bigger than Netflix. Disney doesn't even have 200 million across ESPN Plus, Hulu, or Disney Plus. Netflix is well over 200 million. I think Disney's coming in 160 or 170 with all 3 of them.
Okay. Yeah.
Something like that.
You're right. They have 207 million
for Netflix.
Yeah, Disney Plus is at 109. I'm not sure what.
Yeah, Hulu's like 40 something, 43, I think, and ESPN is like only like a handful of people, like maybe 10.
You know what? I definitely misstated that. I think what I read was it was one of the fastest growing ones.
Yeah, it is the fastest. It's the fastest to get to 100 million.
Yeah. So my bad. I apologize.
Yeah.
You're only human.
Other than that, though, a lot of the growth. The parks are pretty steady Eddie when they're open. I even have a couple friends that visit the parks pretty often, and they're grown people, and they're visiting there quite often without kids, and now they have kids, so they're gonna be going there even more. So it's definitely a big thing. And I want to get back to the parks as well. We haven't been in years, so we'd like to go. That's a super stable part of the business, and that real estate there is always going to be worth billions of dollars. So
I'm going in October.
It's certainly steady Eddie, and that's what's really carried them to this point, and that's kind of what that anchor in Disney is. But for all the new growth moving forward, it's going to come from this media and streaming and entertainment. That's where all this growth moving forward is going to be. So they've been doing pretty well with Disney Plus, I think, and I think as time goes on, that will account for a bigger and bigger portion of revenue. I know that they had a significant pullback in their speed of subscriber growth in the last quarter.
Yes.
And so it'll be interesting to see if that's a one-off or if that's going to continue to be the problem.
There's a good chance because everything's opening back up, and with the vaccine, probably it's going to slow down dramatically their rise, but I don't think it's going to stop because they're just with the turning out of content that they're doing and moving stuff away from the theaters. Right. You could start see a good steady growth.
So I quickly looked on some information on their streaming service. Their CEO said that they expect the streaming service to hit between 230 to 260 million subscribers within the next 3 years. So make of that what you will. I don't think that's gonna happen, like Phil said. I think now that COVID's ending, that's why we saw so many new subscribers. There's nothing to do.
They launched nearly at the perfect time to launch a streaming service.
It was perfect.
And 2 years, I mean, 2 years from now, I think Netflix is going to have a tough time hitting 260. So it's just, I think that market is starting to really, really saturate. And I think everybody who's there is pretty much there at this point. So I think growth is going to be pretty slow moving forward. They'll think of clever ways to increase that revenue over the years, though. Disney Plus as well. Of course, they do control the Star Wars franchise.
Yeah.
So they do have options for new Star Wars. I just don't think, and this is a knock on AMC shareholders. Eventually, it's just not going to be released in theaters anymore. It's going to appear on Disney Plus. It is. Forget everything that you think about AMC. It's just way too expensive. Nobody wants to go there.
Specifically, Disney staying with the family-oriented shows and movies. It's, if a family knows it's going to cost them only $30, whereas going to the movie, just 2 tickets is $30, and you have a brood of kids that you're bringing. You have the birthday parties. It's easier, put on the rent the movie, buy the movie, and you have access to it.
Absolutely.
So it's
and never mind the tickets. Like the popcorn and drink is like over $10 itself.
That's $100. I remember my dad just taking my family, and we were a family of 5, and this is back in the early 90s. It was close to $100, the tickets and the food. So with inflation, it's now you're looking at close to $200.
It's crazy.
My uncle just went there. Parking alone is over $100. Forget food.
Yeah, so that's where, even if subscriber growth cools down, a lot of new movies are going to start to be released. Like you said, what was it? Black Widow, you said?
Black Widow was the most successful movie released in the pandemic so far.
And so that will continue to be a thing. I know.
On stream.
Who had Mortal Kombat? Did anybody have
Warner
that?
Brothers. Warner Brothers.
Okay, I saw that. I think it was for sale. I don't know if it's Netflix or Prime Video, but
Prime.
Okay, yeah. So a lot of these new movies are going to be coming on this avenue, and that's how these streaming platforms are going to make that additional revenue. So Disney, though, I mean, it's okay. I mean, I wouldn't recommend buying it, but if someone had it in their portfolio, I wouldn't exactly say it's a bad thing. I think
you could do a lot worse.
I think they have fun.
Look, Disney is one of those companies that we know will, as long as they concentrate on 2 things, the parks and they're creating content for kids. They're going to be printing money all the way to the end of time.
Yeah, exactly. The parks provide the base revenue. And parks provide revenue, and the growth is going to come from media and entertainment as far as streaming goes. So I think it's all around good.
Yeah, I mean, I'm looking at their last quarter, and I mean they're up almost 100% in net income. So I mean they made $90 million the first quarter of this year. So that's a big increase from last year. Last year, their best quarter was $17 million in net income, and then all the other quarters they lost money. So
because of the pandemic, are all the parks open now?
I think they're open. My uncle just went to the one in California. They even opened up the Star Wars exhibits and all that stuff too. So I guess they're pretty much fully operational. I'm not sure if they have like a limit, like a people restriction, but they're open. So like you said, I there's so many other better stocks to buy.
At a lower, that provide the same, but at a lower price point, right?
I just think all the news of Disney Plus, they had a lot of good news in the last 6 months for Disney. So I just think the stock price got too overinflated, much like everything else in the market. But I mean, right now they're trading almost 4-to-1 price to book. So to me, it's definitely way overvalued.
Yeah, if you're looking for, like I said, if Disney's already in your portfolio, I think if you hold it for 10 years, you're going to make a lot of money. But if you're looking for an aggressive grower and you're looking to capitalize on that movie streaming specifically, Netflix is going to be the better bet. Just because they are the leader in terms of subscribers. And what else was I going to say here? They've been able to raise pricing without losing anybody. And Disney Plus is very cheap, and we all know from Netflix, it's not going to stay there. So, And the question is, when they raise, are they going to be as successful at holding on to clients as Netflix was? Netflix doesn't have to raise for a while now, but Disney's going to have to raise shortly. And do people just run off the ship? So for that reason, I would say if you want,
they're going to need compelling content to keep people.
And they've gotten that compelling content.
All the big guys.
Yeah, they do have some compelling content. They have good stuff. You know, listen, if you're going to buy, if you say you want to buy 10 shares of Disney and you plan to hold it for 10 years,
you're going to be fine. Yeah.
Yeah, you'll be fine. But if you're going to buy 10 shares of Disney and try to flip it in 2 years, I'd be like, I don't think that's going to work.
Yeah.
So
all right.
It all depends on what your expectations are, you know?
Excellent. All right. So we're moving on to the next one. We're doing Plug Power, correct, Dalt?
Yep. I'm leading off with Plug Power. So yeah, Plug Power. I actually held this stock. Yeah, I did. I did hold it. I wrote an article last year in, I think, September. I'm just going to quickly search on my blog. I think it was September.
Make sure, guys, when you're here watching, let us know you like the show by giving us a thumbs up, commenting. If you have any questions regarding the stock that we're reviewing, let us know. Ask that question. We'll answer it live on air so that you guys can be part of this the show, so that it's a very friendly and everyone benefits from it. So yeah, Dalt.
Yeah. So I wrote an article on Plug. I wasn't on Plug Power. It was actually on Hydrogen Power. It was called Hydrogen Power, How to Profit from the Quiet Rise in Fuel Cell Technology and Grid Supplementation. And one of the companies that I talked about 4 companies there. 2 of them were in hydrogen fuel cell production, and the other 2 were in the production of hydrogen gas. And so I talked about Plug Power and Ballard Power Systems on the 17th of September last year. And at the time, Plug Power was at $12.94. So I bought in at, I think, 14 and change, and I sold at $58. And
nice.
I made a lot of money, and since it's come flying down. So the issue with Plug Power is, it's not that it's an issue, but all of those hydrogen systems is mostly geared towards warehousing. It's geared towards forklift and other sort of product moving machines versus kind of automobiles or motor vehicles. So that's what Plug Power is focused on. And I was in it for a short trade because there was a huge wave at that point building for hydrogen fuel, and it didn't really matter what you owned back then. Anything that had anything with hydrogen fuel around it was going to go through the roof. So if you're still holding, and if you bought above 60, and now, of course, we're down to $26, this company is still going to grow. They're going to face some competition in the near term with fully electrical forklifts and other, as I said, product moving machines. But they're, how do I put this?
If you bought it at 60, you're screwed. That's
You are screwed.
Yeah.
You're totally coming in and just like ripping off the Band-Aid.
Yeah.
It's not going back up to 60.
Yeah, no. So losses are actually building. So it's not the best place to be. This company will turn a profit in about a couple of years, but it's going to be a very small profit, and it's just going to be a matter of how much market share can these guys attack. And I would imagine that, like I said, in the near term, there's going to be people building electrical forklifts and all types of electrical products that move in and around warehouses, and it's going to really eat into Plug Power's revenue. So, yeah, there's that. I don't really have anything more to say about it. I got in, and I got out. So that's.
Yeah, I'm going to give Plug 2 thumbs down. If you bought it like in the early 20s or maybe high teens, and you want to try holding it for a couple years, sure. But other than that, I don't really see too much. Like you said, it's going to take years for this company to turn a profit, and there's so much competition. I don't know. We'll see what happens, but I'm pretty low on this one. I would sell it if I had any profit at all right now, to be honest. So
on another related note here, just to say, If you go to my blog and you use the blog search and you search for hydrogen, the word hydrogen, that article is going to come up. What's more interesting in that article is the grid supplementation with hydrogen gas. So companies like Lind, PLC, and Air Products and Chemicals, these companies actually create hydrogen gas. And a lot of utilities in California, because California is always the first to go super green because they're a blue state notoriously. So a lot of Californian utilities that run natural gas-fired electricity turbines, they're all switching over to change their turbines to manage on hydrogen gas. So instead of burning natural gas, methane, they're going to be burning hydrogen. And hydrogen is a clean burn. When you burn it, it just creates water, right? So as you burn it and throw it through the turbine, the only reaction is going to be water. So they're moving towards that. And there's a lot too in southwestern United States that are also adapting their natural gas-fired turbines to take in hydrogen. And companies that create hydrogen are going to be the ones that get all this business, right? So Lind PLC is one of them, Air Products and Chemicals. There's a few others as well. I think that part of the segment, like I've been looking at taking a position in Air Products and Chemicals for a while now. That part of it is going to have real long-term implications because I don't see us burning methane forever.
Okay. Now we're moving off to the final one. Whoops, what's going on there?
Yeah, NIO. That's the one everybody wants. That's the one that we got a lot of votes on. Yeah.
Here we go. Let's bring up the NIO stuff right here. And Tony, tell us about NIO and what's going on there.
Look, we talked about this one in depth probably like a month or two ago, but I would say NIO, the thing with NIO is people are pretending that, or hoping, I should say, that this is going to be the next Tesla, where they buy it at $20, $30, $40, $50, and 2-3 years from now, it's up to $2,500 a share like Tesla was before the split, or $3,000 a share. And they're hoping that that's exactly what they're hoping. Because right now, there's really no good reason to buy NIO, to be honest, because this company is valued at 17 times book value. So their market price is 17 times book value. In comparison, Ford is 1.7 times book value. So the price to book ratio, usually anything 3-to-1 and under is pretty reasonable. So that gives you some comparison if you're comparing another EV company or a company that's going to be heavy into EV like Ford. They're 1.7, NIO 17-to-1. So this company's current evaluation, it's trading like a company that has strong profits and is selling hundreds of thousands of cars per quarter. But in reality, they're only selling 20,000 cars, and that was their best quarter last quarter. I would say the reason this is never going to be Tesla is because, one, they don't have a figurehead CEO like Elon Musk that is polarizing, that gets a lot of attention. And two, there's so much competition in the Chinese EV field, and Tesla is actually in China too. And I think they're probably going to be the company that dominates the Chinese market. There are several other ones as well, Xpeng, and there's a couple other ones that are very strong in the Chinese market. This company, if you like, we could pull up their earnings, and I did earlier.
Is that the photo that you sent me just last?
Money. Yeah, I mean, they lose so much money. They lost.
This is the thing you're talking about?
Yeah, this past quarter alone, they lost $4.87 billion in one quarter. So they have a revenue of about $8 billion, but they lost nearly $5 billion in net income. So, and then if you look at 2020, they lost $1.4 billion. The next quarter, they lost 1.2, then 1.2 billion. So you're looking at a total of 4.
Just right here, net profit margin negative 61%.
Yeah. You're looking at about $8 billion in the past year of net income losses. So how long can a company sustain billions of dollars of losses every quarter before they turn a profit? I don't know. I will say that the one thing this company has into their advantage, and it's a huge advantage, and I don't even understand how they got this, but if you look at these quarterly financials, they have $28 billion in cash on hand, which I don't understand how they have $28 billion of cash.
I know how.
Well, I'm assuming it's
communist
Chinese government subsidies.
Yeah.
And
Exactly.
really the Chinese government is propping this company up because this company, they do sell cars. I'll give them that. They're not some like workhorse or fake car company that just has a fake prototype and that doesn't actually run. They do sell cars. Their cars are not horrible from what I've seen from videos. I watched some videos on them, but they're so far away from turning a profit. It's not even funny. I mean, they're losing billions of dollars every quarter.
I would not invest in this with a 12-foot pole.
So, I mean, the question is, and this is the billion-dollar question, when will this company turn a profit? And will they turn a profit before they run out of funds and go out of business? So, I
have a question for you, Tony, regarding this before we jump into Dalt's analysis of this. Do you know how long it took Tesla to turn a profit, or either one of you guys?
Well, I would say technically they're still not turning a profit if you take out the government subsidies.
Yeah.
But it did. So I did go back and I looked at Tesla, and Tesla was kind of on the same trajectory where they took a very long time. But the difference with Tesla is if you pull up their earnings, every quarter you could see they were losing less and less money.
Okay.
So you could see that they were trending up. Their earnings per share were going up. And with NIO, this is the biggest loss they've ever had in a quarter.
Yeah.
And they've sold the most cars they've ever had in a quarter. So,
if
when
we look at
going to reach that turning point where they're going to make money? Could be years. I don't know. So selling 20,000 cars in a market with 1 billion people is not going to cut it.
My question here is this cost of revenue. It says it's 6.43 billion. Does that mean that it cost them that much money to make the $7 billion up here?
That's exactly what it means.
Jesus.
Probably like production costs, marketing, all kinds of other costs that go into it. Yeah.
It's not good.
That is not something I would want.
So if you
and it's up
Tesla,
317%. Jesus.
So if you look at Tesla, the difference between NIO and Tesla is if you go back to last year, you could see that the first quarter they're actually starting to turn a profit. They're making 104 million net income, 330 net income, 270 net income, and then the latest quarter 438 net income. So even though it's government subsidized, they're still in the green. They're in the positive. NIO, it just seems they're so far away. I just don't know what it's going to take. And they don't, and like I said, they don't have Elon Musk. Musk is such a huge advantage to Tesla, and there is no Elon Musk for NIO. So I think NIO's hype was they were branded as the Chinese Tesla, and a lot of people jumped on that. And they wanted, like I said earlier, they want to find the next Tesla, and they want to get in early and have massive profits. And that's kind of like a black swan event. It's very rare. You don't see things like Tesla happening often. So that's my take.
Awesome. All right, Dalt, you want to jump on this last bit of review before we end the show?
Yeah, he touched on a lot of great points, and the one thing there he ended off with, and I was hoping he would get to it, is Elon Musk. That's really the game changer. Banks really trust Elon. He can tap public markets every month. He could issue shares every single month of the year, and some bank would be out there underwriting him because they know they can turn off those shares into the market. And retail investors just love Tesla. They love Tesla more than they love their own flipping parents, their significant other, their brother and sister. They really love Tesla. Yeah. So Elon can just keep going or tapping those public markets. And I know this is the case because every time he issues shares, the shares seem to double and triple, which makes no sense because there's actually the company should be losing value, but somehow they keep skyrocketing. So
it's the trust in Tesla. It's the trust in Elon.
Yeah, people really, really love it. So you can't really compare NIO to it.
And to Dalt's point, last year there was an article that 39% of Americans, or it was in the 30s, I can't remember exactly, 39% of Americans make investment decisions based on Elon Musk tweets. Who's the CEO of NIO? Go ahead. Nobody could guess it in a million years, and nobody's making investments based on any of his tweets. So.
That's exactly yeah. So it's just the amount of money that Elon can access at any one time without issuing debt is just amazing, and that's what's keeping Tesla up there. But exactly as Tony said as well, and I talk about this in my article, How to Research a Stock. If you're not making money, you better be raising revenue, gaining market share, or at the very least, every quarter you want to see that those losses, getting less and less. Those losses should be slimming down every quarter. So you lose 500 million, fine. Next quarter, you better lose less than 500 million. And the quarter after that, you better lose less than you just lost again. When you have companies like NIO that are just losing more and more money every quarter, that's not good. You're going the wrong way, especially when you're subsidized by China. So the big cash on the balance sheet, they are still subsidized by China, as all Chinese companies are. What's interesting about the electric automobile market in China is phasing out the subsidies across all EV makers in China. So NIO will get less money this year than they got last year, and 2022 they'll get less money than they got this year too. And so with the money running out, there's now pressure on them to turn a profit, or those losses are going to be even bigger than they have been. So you got to watch out for that. Everything coming out of China is subsidized, so you never really know just how competitive these companies actually are until you take away the pacifier and the tit, and then you really realize, oh well, I guess NIO can't stand on its own when China's not pumping a few $1 billion per year into the company. One thing that they should be doing under subsidies is raising revenue magnificently. And they've been able to do that. So revenue more than doubled from 2019 into 2020, or sorry, nearly doubled from 2019 into 2020. But the interesting thing with that is they still had massive losses. So again, raising revenue is an easy thing to do when you have subsidies. So we'll have to wait and see as to whether or not NIO can stand on its own without these massive subsidies. And again, with this Chinese stuff, not that I have anything against China, but honestly, the Chinese government sits on the board of every Chinese company. It is communism over there.
I think that's important. Like you said, we don't have anything against Chinese people or the Chinese or China at all. It's the Chinese Communist Party. Yeah, that's what it's the government.
Somebody from the government sits on every Chinese board. You saw what they did with Alibaba last year. And now every Chinese company that's listed on American Exchange is feeling the pain. You name it, Momo, NIO, Alibaba, doesn't matter what it is. They're all feeling the pain. So, I wouldn't go anywhere near these companies right now because you know what? China just told Didi to take its app off all the app stores. So in certain countries, that's freaking crazy. Like, again, like Chinese companies, I would just stay very, very far away, especially Chinese EV makers. And last point I have is, does anybody remember BYD? Yeah. BYD was one of the first EV companies to come out of China. Warren Buffett was a huge investor in that. I think he owned 10% of the company at one point. They're the most profitable EV maker. Like, they're the most profitable. And it seems like everybody just kind of forgot about them. And they're just kind of been sitting there doing their thing year over year. But they make money. And so as subsidies wind down, I would want to be more aligned. If I wanted to be in a Chinese EV maker, which I don't, I want to be anywhere near China. But if you did, I would start looking at the guys that are already profitable.
Excellent. All right, so we're going to round it out. Tony, we're going to start with you. Tell us where we can find you and get in contact with you if we need to.
Well, the Stock Bros podcast, as always, and also, I'm always all over the group. People can try to message me. I try to respond, but I have my messages turned off, so I don't check them often. And you can check out my investing for beginners course. That's doing pretty well. I can put that link in the comments as well. So
excellent. Thank you
thanks
so
for
much.
the support. Yeah.
Always welcome. And Dalt, where can they find you, follow you, and understand what's going on in the world of finance?
Always on the blog, always in the group, and my Instagram, which I've been pushing a lot lately. So at Risme Life. I know a lot of people have come over from the group and started following me there to see my stories. Again, I post a lot of Wall Street Journal content in my stories. So if you don't want to pay for the subscription and you want those free little news tweets that I get in my email every day, please subscribe to my page and follow along with my story. And of course, every Saturday I do live videos for my Insta as well. So always great.
Excellent. And if you want to follow me because you want to learn how to be an entrepreneur, you can go to investinyourselfpod.com and listen to the Digital Entrepreneur Podcast. As always, we want to thank you for tuning in to Stock Dirty to Me, the Stock Breakdown Edition. And we look forward to talking to you in the future. Bye, everyone.
Thanks, everybody.